In 2008, a lot of normal investors thought they were diversified. They owned a house, they owned bank stocks, they owned an index fund, they owned some corporate bonds. Then the same storm hit all of it at once. Home prices fell, banks cratered, credit spreads blew out, and even diversified-looking portfolios moved together. That is the moment I want you to picture. When everything you thought was separate turns out to be the same bet. If diversification is supposed to protect you, why does it fail right when you need it most? I think of diversification as the art of not needing to be right about one story. It is not about owning many things. It is about owning things that fail for different reasons, at different times, and with different speeds. That last part matters. Speed is risk too. A slow loss you can adapt to. A fast loss can force you to sell at the worst time. Let me define a few terms in plain English so we stay grounded. Volatility is how much your portfolio wiggles. It is the size of the ups and downs. Correlation is how often two investments move together. It is a measure of sameness under stress. Drawdown is the drop from your peak to your low. It is what pain feels like in real time. Tail risk is the rare bad event. It is the crash that does not show up in average years. Risk of ruin is the chance you lose so much you cannot recover. It is the point where the game ends. Beginners often think diversification means owning 10 stocks instead of one. That can reduce single company blowups like fraud, lawsuits, or one bad product cycle. It helps, but it does not solve the bigger problem, which is factor exposure. A factor is a hidden driver of returns, like growth versus value, interest rates, credit conditions, or commodity sensitivity. In 2000, plenty of people owned many tech names. They were diversified by count, not by risk. When the dot-com bubble broke, correlation jumped toward 1. Everything that depended on the same optimism and the same cheap capital fell together. This is why I like to start with a simple question. What is the one thing that could break my whole plan? Not a headline, not a scary story, the actual mechanism. Is it a recession, inflation, a liquidity freeze, a rate shock, a currency move, a policy shift, a regime change in how markets behave? A regime shift is when the rules of the game change, like going from falling rates for decades to rising rates, or from stable inflation to unstable inflation. Ray Dalio made the idea of risk parity popular, which is a way to spread risk instead of dollars. Risk parity means you do not let one asset dominate your portfolio just because it is more volatile. Stocks usually swing more than bonds, so a simple 60-40 portfolio often has most of its risk coming from stocks. Risk parity tries to balance the contribution to volatility. This is a useful concept for beginners because it highlights a core truth. You are not allocating money, you are allocating risk. Now let me bring in a case study that is painful but educational. LTCM in 1998. Long-term capital management was run by very smart people, including Nobel Prize winners. They had diversification on paper across many trades. The problem was leverage and liquidity. Leverage is borrowed exposure. It magnifies both gains and losses. Liquidity is how easily you can exit without moving the price. LTCM held positions that looked uncorrelated in calm markets. In stress, correlations went to 1 and liquidity vanished. When everyone tried to reduce risk at the same time, spreads widened everywhere. Their models assumed the past would resemble the future. The tail showed up, and leverage turned a bad month into an existential event. That is a key lesson. Diversification does not work if you are forced to sell. Another case study, Barings and Nick Leeson. That was not a diversification failure in the portfolio sense. It was a control failure. But it teaches a beginner something essential. Concentration can hide inside an organization. Incentives can reward risk-taking that looks like skill. A rogue trader can build a position that is effectively one huge bet. The firm thinks it is fine because reports are wrong or ignored. The lesson for you as an individual investor is simple. If you do not know what you own and why it moves, you do not have diversification. You have a story you tell yourself. So, what does practical diversification look like for a beginner who has a job, a family, and limited time? First, I respect the base rate. Base rate means what usually happens, not what I hope happens. The base rate is that most single stocks underperform the index over long periods. The base rate is also that markets have occasional deep drawdowns. If I accept those base rates, I stop trying to design a portfolio that never dips. I start designing a portfolio that I can hold through dips without panic selling. Second, I separate goals by time horizon. Time horizon is how long until I need the money. A beginner mistake is mixing near-term cash needs with long-term growth assets. If you might need the money in 2 years, you cannot pretend you have a 10-year horizon. The market does not care about your plans. A cash buffer and high-quality short-term bonds can look boring, but they reduce forced selling. Forced selling is one of the main ways people convert volatility into permanent loss. Third, I diversify across economic outcomes, not just tickers. Stocks tend to do well when growth is decent and inflation is not out of control. High-quality bonds tend to help when growth collapses and rates fall, though that is less reliable when starting yields are low. Inflation-linked bonds and real assets can help when inflation surprises higher. Commodities can be volatile, but they can provide convexity in certain inflation shocks. Convexity is when your payoff accelerates in one direction. It is like insurance that helps more when things get worse. Nothing is perfect, but the idea is to avoid a portfolio where every holding needs the same macro environment. Fourth, I diversify by geography and currency exposure with humility. The United States has been a dominant market for a long time. That can create home country bias, which is the tendency to overinvest in what feels familiar. International diversification can reduce dependence on one political and economic system. It can also introduce currency risk, which is the risk that exchange rates move against you. That trade-off is real. Diversification is not free. It is a choice about which risks you are willing to carry. Fifth, I think about concentration limits. Warren Buffett is famous for saying diversification is protection against ignorance. I agree with the spirit. If you truly understand a business and you can live with the drawdowns, concentration can make sense, but most beginners do not have that edge. Charlie Munger also pushed the idea of a few great bets, but he was talking about a very high bar of understanding and temperament. Temperament is your ability to stick to a plan when it feels wrong. If you are building skill, broad diversification is not a sign of weakness. It is a risk control while you learn. Now let me talk about the behavioral side, because that's where diversification often fails. People chase what just worked. That is recency bias, the tendency to overweight the recent past. They also anchor on a high watermark, which makes normal drawdowns feel like personal failure. Diversification can feel frustrating in good times because something in your portfolio will always be lagging. That frustration is the price you pay for not needing to predict the next winner. Another trap is false diversification through products that hold the same underlying risk. In 2021, many portfolios held U.S. growth stocks, a tech-heavy index fund, a thematic innovation fund, and a few popular mega-cap names. That is one trade with different wrappers. When rates rose in 2022, long-duration assets fell. Duration is sensitivity to interest rates. It is how much a price moves when yields move. Growth stocks often behave like long-duration assets because their value depends on cash flows far in the future. So the portfolio that looked diversified was actually a leveraged bet on low rates and abundant liquidity. Liquidity risk shows up here too. In calm markets, you can sell almost anything. In stress, the bid disappears. That matters for small caps, high-yield credit, certain ETFs, and anything that is crowded. Crowding means too many people are in the same trade. When the exit is narrow, diversification can fail because everyone is trying to do the same thing at once. So I keep coming back to position sizing. Position sizing is how big each bet is. You can own 10 assets and still be concentrated if one position is huge or if one factor dominates. The simplest beginner rule is to avoid any single position that can wreck your plan. That is not about being timid. It is about staying in the game. Paul Tudor Jones has talked for years about defense and surviving. George Soros is known for big bets, but he also cut risk when he thought he was wrong. Stanley Druckenmiller has emphasized that great investing is not just making money, it is not losing money when you are wrong. The common thread is respect for drawdowns. Expected value is another useful idea. Expected value is the average outcome if you could repeat the decision many times. Diversification is a way to make your expected value more reliable. You reduce the chance that one unlucky outcome dominates your life. You trade some upside for a smoother path. That smoother path is not cosmetic. It reduces the odds you make a catastrophic behavioral mistake. Some people ask about the Kelly criterion. Kelly is a formula for sizing bets to maximize long-run growth. It assumes you know the edge and the odds. In real markets, we rarely know those inputs with confidence. For beginners, the practical lesson of Kelly is not the math. It is the warning. Overbetting is the fastest way to blow up. Underbetting might slow you down, but it keeps you alive while you learn. Diversification also includes how you add and remove risk over time. Rebalancing is selling what went up and buying what went down to return to your target mix. It feels unnatural, it fights momentum, but it forces discipline. It is a way to buy low and sell high without predicting.